Good evening. This is Ken Long from Tortoise Capital Management with a review of the daily trading plan for January 18th, 2011. We have a market that is in bull quiet. It's overbought on an annual basis with a 74 in the weekly RSI and 99 overbought on the 10-day index. The 200-day moving average percent stretch is at 13.02, which is very bullish, as you can see by it being highlighted in green. The slope of the 50-day moving average at 0.77 is also extremely bullish. ADX at 34.4 is so strong as to be exceptional in terms of trendiness. It's rare for ADX and SPY to be greater than 35 for extended periods, and so this is a warning to ensure that you are honoring your stops. You're continuing to take long signals, but you are aware of the possibility of a sea change in the days and weeks ahead. ATR percentage at 0.75% is what gets us into quiet mode. You can see on the SPY volatility chart here that it had bottomed out around 0.50 and is now hooking back up. When it gets above 0.90%, then we will be back into bullish normal, which is still very favorable. It's just we've run through a period of extraordinary low volatility here in the last month or so. No signals on the overreaction or channeling signals. I do want to draw your attention to the gap stat, which shows that over the last 30 days, 67% of the time, the market has reversed its gap. So it's either gapped down and reversed to close higher, or it's gapped up and then reversed to close lower than the opening. So that's happened 2/3 of the time. That's an important trend. The best intraday move on average is still about 2.37%. The average gap is still 0.74%. You can see on the 10-day index that we've been overbought for most of the last 10 days, except for a couple moments when we dipped below. Pivot point is at 128.91, and even S3 is well above, $4 above the previous support levels that we saw as key at 123. Again, we have a runaway bull market here. 10-day max pain, some old familiars, Merck, Verizon, McDonald's, Alcoa, and Coke. We're going to see that Merck is 10-day max pain. 3-day max pain was a daily loser on Friday, and so it, unlike the rest of the Dow, closed below its 10-day trading range, and so it's an anomaly. Good chance for some bottom feeders to capitalize on it. You can see the strength in the ADX has been moving up steadily till it's right about 35 these days. Very few pattern trades, although we do have signals in Alcoa, Disney, and Microsoft for 551W. The Elder Safe Zone, because of Friday's strong close, gave us increased strength ratings in lots of the broad indexes, and only the VIX and Silver Wheaton got measurably weaker on Friday. 3060 Stealth continues with defensive sectors, utilities, and financials, and Brazil has crept in there as well. The large cap stealth in Pfizer, Bank of America, and Merck. Looking at the daily tactical, you can see again Merck was a 10-day and a 3-day max pain. It's the only one that closed below its 10-day trading range on Friday, and so that's why it is a object of interest. Let's try and raise it up just a little bit for you. McDonald's I do like because it was a 10-day max pain, but it was a percent winner on Friday, and that means the recovery may already be in place. Alcoa is teasing us with a price at right about 16 once more, and that looks very favorable. If it can break through 16, that's going to be a good sign and get to 16.5 pretty quickly. Home Depot, American Express, Bank of America among the percent leaders on Friday, but then also on the last 3 and 10 days, and that reflects the strength that we would see in commodities, basic industries, and financials. Over on the ETF side, you can see the extraordinary number of ETFs that are overbought on a 52-week and a 10-day basis. Financials were a big winner on Friday, and only the precious metals and coal gave back a little bit. Natural gas had a strong finish to close above 6. In the pattern summary for the Dow, only a handful of dojis, one channeling signal in Coke. Coca-Cola is in excellent posture right now as a max pain range compression. So is McDonald's. What I like about McDonald's here, you can see it's a max pain 10-day, 1 month, 3 month, but was a percent winner on Friday. And so that may be the start of a nice recovery. You can see just how horrible Merck has been. It's been high max pain in any time period you want to look at. And it's number 4 in the max pain range compression. I like the 551W signals in Alcoa, Disney, and Microsoft. In ETF land, no dojis, only a couple channeling signals in gold and silver. You can see they've been suffering lately in their pullbacks while the strength has moved into equities. So gold and silver on sale right now. They've lost less than 10% from their swing highs. They're very volatile, especially silver, but there's opportunities now for traders to buy them on sale. You can see the strength that has been coming into financials here lately with all the highlights in green. The Elder Safe Zone strategy, the channeling strategy, again, only the VIX and SLW signaled weakening on Friday, and almost everything fired stronger here in the form of large indexes. The R2 statistic for the 30-day regression line at 0.96, it almost mathematically can't get any stronger than that. You can see there's almost no variation at all in this 30-day trend. You can see that the trend line has hooked back up. It's still about 1 standard deviation above average. You can see what that corresponds to on the price chart here. What concerns me is that the percent stretch is almost 2 standard deviations above normal, and it's getting up into nosebleed territory. It's hard to see it getting any stronger. It could continue on this glide path, but it would take continued buying pressure. It could go sideways for 30 days and still remain above normal on the percent stretch and on the slope of the regression line. So we've seen some cooling off in the U.S. market over the last couple of weeks as financials and the Asian tigers have begun to resume their strength. But we could definitely see more of the same. On the quality report for the Dow, again, I like to sort this by 2 months ago, and I look for red 2 months ago and then yellow on the 1 month ago. And so when I look for red then yellow, I'm looking at Merck and Kraft, to a lesser extent Boeing. At the top end, you can see how things that were exceptional 2 months ago are now starting to suffer on the 30-day, and so it's not unusual to see the cycling starting to occur after 1 month. You would not be wrong to continue to look at ExxonMobil. I mean, it was green 3 months ago, green 2 months ago, green this month, and that's just a reflection of the strength in the energy sector. But that's how you read that chart. Over in ETF land, looking for red, then yellow, we'd be looking at Europe and then the utilities and Brazil, and that's why they're on the stealth chart. Looking at the holding of the 10-day periods, again, I like looking at the Z-scores. Those are the numbers of standard deviations the current move has made looking back 10 years. And so what's suffering right now really is only silver and gold. On a 10-day basis, how you read this, silver has lost 5.91%, and that puts it right at about 1 standard deviation below average. And so that's about a normal normal 10-day pullback, and so that almost gives you a triple screen kind of a condition. Gold has not sold off quite as much, and it's interesting to note that silver still remains positive on the 40-day holding period and is one of the strongest sectors still. So there's a definite buy-on dip opportunity developing in silver and gold.